Hello there. Welcome. My name is Marche. I'm the webinar director here at Advice Chaser, and I want to thank you for coming today. Before we get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during the question and answer period or during the webinar as appropriate. I do want to say that sometimes we don't have a chance to get to everyone's questions, and if we're not able to get to your question, go ahead and leave your contact information in the chat box as well, and we'll make sure someone reaches out to you after today's event. Make sure that gets addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our speaker today. And let me go ahead and get your picture up here, Sean. Sean McElderry is the CEO and founder of Monarch Wealth and Retirement Strategies. He is a certified financial fiduciary and has over 22 years of experience in the financial services industry. As financial professionals, Sean and his team are committed to helping people create solutions for their retirement assets. Once they understand risk tolerance, time horizon, and goals, they work to develop a program that carefully balances investment strategies with preserving principal. And Sean, I know you've been a guest of ours several times, and we're glad to have you back. In
Thank
fact,
you, Marche.
and we do have another webinar coming up real soon that you'll be a guest on as well. And so I hope our attendees will also look forward to that. But I'm going to go ahead and turn the time over to you to talk about this important topic. Your emotional EKG is your mind getting in the way of your money.
Yes, thank you so much, Marche, and appreciate you having us on. So yeah, I'm going to try to cover this topic, and we do a couple presentations on this theme, which can go quite long. So this is going to be a lot more condensed, kind of like try to hit some of the main power issues that people are really, maybe experiencing and not aware of, and really how we can kind of get you to be more conscious of how you're making decisions, so you're not letting kind of your emotions steer what it is you're trying to do. So we're really trying to kind of dig into, help you uncover how do successful investors tend to fare better, and what kind of things can we do to improve that. So we'll go ahead and jump in and talk about that. Expectations, whenever you talk to a financial advisor or wealth manager or whatever type of assistance you're looking for, what you really have to think about is expectations. A lot of times when we talk to clients and we ask them, well, what is it you want this portfolio to do? They often have unreasonable goals, and that can be a problem just in itself. So really understanding what we like to talk about is really aligning your investments with your expectations. And what do I mean by that? Well, oftentimes we'll talk to people that tell me, well, I'm very conservative, Sean. I don't like to take a lot of risk. I don't want to lose large amounts of money. And then we say, okay, let's take a look at what you've been doing. And we look at their 401k, and we'll see somebody that, for example, might have $500,000 invested, and they have 50 or 60 choices in their 401k, but they've chosen to put it all in company stock. Okay. This is an example of not investing. Not only is that super aggressive, that's considered the most, anything over 20% in company stock is considered pretty much something you shouldn't be doing. So when you go to a full portfolio like that, that person's actually doing exactly the opposite of what they're telling us they feel. So what we try to really do is help engage with what is it you've been doing, and maybe there's a reason you're so disappointed in how things are going. Similarly, maybe someone that's very, growth oriented, and they're younger, or even somewhat further away from retirement, they want to make money. We look at their portfolio and they're invested super safe. And when we ask them, well, how did you pick these things? We often get, common answers is, well, my boss told me what to pick, or I don't really know how I got that choice. It just got put in there when I was, starting the 401k, and I've never changed it. So there's a lot of different ways people pick their choices, but when we talk about aligning your investments with your expectations, we're talking about how much risk should you be taking, what are you comfortable with, and then making sure the investments actually match. And that's really the key there. So what should you expect? A lot of people don't really know the answer to this. We can look at all sorts of investment sleeves, real estate, precious metals, the stock market. There's a variety of different components to the stock market. There's bonds, CDs, annuities. So these all have varying risks and returns. So, when you think of just the S&P, simply put, if you're investing anywhere related to the market, you should realize that, and expect that part of that investment experience is every 3.4 years, you're going to expect about a 5% drop, pretty much every 14 weeks. Within a 1.1 year occurrence, you'll see about a 10% drop. So every year, you're going to see that account drop 10% if you're just in the S&P. And, about every, 3 years or so, you're going to see up to 20%. So as you can see, you have to be willing to take some fluctuation. So when you're investing, now we can smooth this type of up and down out by adding other investments in with the S&P. Obviously, you want to be much more diversified, but the point to this is, don't go into investing thinking it's just going to be straight up, or it's never going to go backwards. Part of the experience is it's going to be fluctuating. So just like if you were driving somewhere, you were driving from here to, somewhere 2 or 3 hours away, you would assume you're probably going to hit a bump in the road, right? That would be the same way I think about your money. It's going to be a bumpy ride, but you're going to get there. That's how I would analyze that. So if you keep that in your mind going in, and hey, in the next 3 years, I could drop 10%, and there's a chance it could get worse on each of these. So then it's just a matter of, well, how long is that dip going to occur? And we're going through obviously a dip right now, which is why we're really talking about this. Is this is what separates the investors that come out better, or they make decisions that basically lock in those losses. Okay, so we can go to the next one, Marcia. So, this is probably the most challenging thing. What is your discomfort zone? What are you comfortable with temporarily, hopefully, seeing those declines? And when I say temporarily, if you're diversified correctly, okay, we can really build in kind of what I like to call a gas and brake pedal to your portfolio, where based on what we choose, we have the ability to help give you a gauge of how much fluctuation you're going to see. So if you see on this little graph here, a lot of people like to be in that kind of middle area. Like, they don't like to see it go down. No one likes to see it drop 20% for sure, but that's going to happen occasionally in a good growth portfolio. And of course, as you get more aggressive, those fluctuations can increase, but you also get reward with those fluctuations. You can see that, the portfolio on the far left there, obviously you're going to have much higher gains than the one on the far right, but that comes with a bumpier ride. Okay, so remember, we're not talking about necessarily you losing permanently. We were talking about fluctuations. So if you were to just think of a line kind of going up and down, this would be a much calmer fluctuation on the right, whereas these are going to be a lot more volatile. Does that mean you're not recovering though? You are going to recover. That's the point. So hopefully, right? So if you don't put all your eggs in too few of baskets, then you should see that turnaround. And we'll talk about a little bit more on that in recovery times, but we can go ahead to the next one here. And the way we just figure this out is we ask you a lot of questions. So the discomfort zone is basically your risk profile to give you an idea of where you should be. But another thing, and I'll add to this, is a lot of people, when they retire especially, they invest too risky because they're used to that volatility, and you've got to kind of taper that down as your life changes. So that's something that as you get older or as you have transitions, you want to maybe rethink the fact that you don't want to be all stocks or even 90-10. You want to be maybe 70-30. Okay. So how did you pick your investments? Was it based on what you were trying to achieve your goal? So we talked about that a little bit. The way we pick investments is really first, what we choose is really the last part of the conversation. The first part of the conversation is, what are you trying to achieve? So if you're saving and you're clearly wanting a little bit more growth, then we're going to look for things that are going to work together to give you a good balance. Make sure you're not just putting it all in the S&P 500. A common problem with 401ks is they're very heavy in S&P 500 choices. So sometimes you miss out on things like dividend paying stocks, which can be very good performers during difficult market cycles like we're going through. There's also bonds that you might not have access to in a 401k that have more solid guarantees. So depending on your goals, when you have a financial advisor, you might do certain things in the 401k, and if you're lucky enough to have outside assets, we can use specific things in the 401k to match up with your IRA. So the key here really is we can help you craft what you're selecting. But when we ask people how they pick their investments, if you heard the answers people gave us, it kind of reminds me of some of the talk shows on late night when they go out and ask people on the street, do you know your president's name, or the three branches of government, and people kind of glaze over. This is what we experience, is we get all sorts of answers, but this is not, if you were a very wealthy person and you hired a team to manage your corporation's investments, this would not be how you do your due diligence and you protect your stockholders. So why would you be any less important as an individual? I think that's key, is we have to start thinking of ourselves, giving ourselves permission to say, hey, it's okay to need help and not think that Google is going to answer everything. And I think that's really important, because I spend most of my day talking people off the fence when markets are going like this and keeping their head in it. And over time, the majority of our clients have come to, be educated to where when we go through these downturns, usually the people calling me are the newer clients, and the ones that have been with us for 10, 15, 20 years, I have to call and bug them because they're, they already know what's going on, they're comfortable, and they're okay. So emotionally, that's where we want to get people to, is you pick those investments based on your goals, and we align it with what you're trying to do. And then what's going to happen. So, and that's the perfect slide to kind of follow that, because so whether you're investing on your own or you have help, let's just kind of pretend that where we have this little cartoon happy guy over here on the left. That would have been January of last year and pretty much the prior 2 years, right? We were all feeling this insane growth that was unexpected through COVID. People felt like, hey, their portfolios were higher than ever. We just came out of a pandemic, or whatever you want to come out of it. We're still dealing with it in some sense. But this is where people, what they have to think about is and why this slide is so important is, if you think about last January when it was an all-time high, that was when the market had the most risk, because everything had been bought up to this high point, which means there's less opportunity there. Okay. Now we fast forward to today, the market has de-risked and dropped. So the price of these companies that we're all investing in, whether it's Walmart or, Amazon or Tesla or whatever you're buying, okay, those have all gone on sale in a sense. So you have less risk currently in certain companies, and you also have more opportunity, as opposed to less risk, or more risk and less opportunity. So this is where you have to kind of start tweaking your brain, because Imagine if you invested 2 years ago, you rode the account up to this high point, and then you fell off a cliff and lost money. How does that feel? Well, that's why this kind of shows you people start to kind of worry, and then they have some dread. Maybe they're just completely panicking, and then they get to the point where they just don't want to look at it. They're not even looking at their statements. They don't want to know. I talk to people all the time that are like, I don't even know where I'm at. Okay. When that happens, when it gets to this point, that's a good signal that hopefully we're in a position where things start to turn around. But there's a funny part here that if I was talking to someone that had never invested before, didn't go through this roller coaster, didn't go up and then down, and I said, if you won $1 million in the lottery today, how would you feel about putting the money in the market right now? And most people will tell us, well, I'd feel pretty good about that. The market's really been beat up. Obviously stuff's at a good price. So let's take a look at that historically. If you had cash, when would be the best time to invest? So since, basically, going back here to the early 1900s, what do we go to 1940 something, all the way to today, there's been a little over a dozen times where you can see we had these great growth periods, and then these yellow kind of orange sections are where the market, had a really rough ride. So these opportunities, which we're currently in one now, which doesn't show on this graph, that would be on the far right, these opportunities don't present itself for sometimes many, many years. And so this idea of when would you put the money in? Well, if you put it in now, you have a lot better chance of when it turns around that you're going to have a nice run like this. Now, if you already lost money though, and you're currently sitting in that portfolio that's beat up, you have just as much opportunity there as the person that's thinking about putting in new money. And I think that's where you have to tweak your brain. It's not about what you lost and trying to recover and hope that you're going to get back. You have to think of it that same way. So when people start moving to cash, okay, because they're afraid, they are now giving up that chance to get back on track. And it's very hard to recover if you move to cash, because now you've pulled out of the market. And so my question is, if you look at this chart, if you pulled out, let's just say here's 08, for example. Well, so when would you decide to get back in? So what most people say was, I'll get back in when it starts growing again. Well, look at that first couple, periods there where it really spiked up quickly. In fact, a little factoid would be, from the bottom of the market, we usually historically will see a 38% gain within 18 months. Okay, so that's really important to understand. If you're sitting on the sidelines and not paying attention, you can miss out on that very quickly. But here's the other number that's very important. 80% of what you earn in 1 year. Okay, so if you made 10% for the year, 80% of that number, 8%, is going to happen on how many days of the calendar year per year? Like, how often do you have to be in the market? And the answer to that is, out of all the trading days, 80% of your return occurs on 2 to 3 days historically. And I think that's really probably one of the most powerful things that you can pick up from this whole conversation is, when you're out of the market, if you miss those 2 or 3 days, you miss out on 80% of the recovery. So for people that think they're going to time it, they're going to, because human nature is, we want to protect our well-being, right? We want to protect ourselves from danger. So instinctually, we want to run to cash and wait till it's safe to come out of the house again, right? But the question is that the smartest thing? So what we're trying to do is steer you away from emotion and focus on the fact of, when we set your account up years ago or 6 months ago or whenever, we based it on how you felt and what you could handle. So unless your goals have changed, then stick with the plan that you put in place with your advisor or whoever is helping you do this. If you don't have a plan, then you should probably talk to somebody. But that's I think really important, is stick to your plan and don't let the emotion steer you off course, because it can have a big effect on earnings. Okay, Marcia, we can go to the next one. So this is a big question. People say, well, what happens if I buy in and the market's just going to tank again? What would happen if I bought in before a major downturn? So here's 3 of the worst downturns we've seen: the tech bubble back in March of 2000, That's where a lot of people were very heavy in the NASDAQ. If you had bought right in before that bubble through today, you'd still have 169% gain. If you bought in 2001, you'd have a 276% gain. And if you bought in right before the downturn of '08, you'd have that 163. So buying in before a downturn, sure, you're going to take that dip, but you're still going to be profitable over long periods of time. Okay. The S&P, which is just one component of the market, over any 10-year period in history, if you took 90 to 2000, 91 to 2001, pretty much going back, those averages for 10 years tend to be very consistent. You're going to be getting that north of 10% return, but you've got to stay in it and not be jumping in and out. Next one, Marche. So, we talk to a lot of people that call in, they get nervous, they start talking about all these things. They call me up and they say, no, I know what's going to happen because I'm worried about, and there's usually something that they want to talk about, whether it's, gas prices, inflation, jobs, politics, the supply chain issues, all these things are an issue. So let's kind of take some of these on. We'll start with a couple at the bottom first. Supply chain issues, gas prices, the recession. So really, I think, when you think just logically and you put aside what we all want to be going on, I think we all can agree that we went through a pandemic and really anything could have happened, not only here, but globally. People want to get through things without any injury. And we kind of held it all together with duct tape in a sense. But what you're seeing is this residual of the fact that while nothing really bad happened in 2021 to most people, and they kept their jobs, they started rehiring, the market turned around fairly quickly. We're now seeing the residual effect on that. And I think when we all want somebody or something to blame, I think that's a bad way to look at it, because there is no one person to blame. There's no one political party to blame. It's not about religion or any other factor. What it really comes down to is, we're all trying to get to a better goal, right? We're trying to get to a better place is how is the economy going to heal? And so we should focus really on what's working first. And I think, we do have a great job market. It's strong. A lot of people were able to get reemployed. The supply chain issue is, well, think about it. We're all upset because we can't buy stuff fast enough. Think about that for a minute. We all are so excited to spend our hard-earned money that we're upset that stuff's stuck on a boat out in the harbor, right? So do you think that's a strong sign of the economy or a poor sign of the economy? It means that we have to fix the supply chain has a lot of lagging points. And, I don't know if anyone knows about toilet paper, but we learned a lot about that during COVID, okay? So let's talk about the supply chain issue there. Why did everyone have a toilet paper shortage other than the hermit that was storing it in their garage? Okay, if anyone knows, they can throw it in the chat. But I'll tell you what I came to learn, because I had to Google this finally and see what was going on. Why is it suddenly, we're dealing with this? So part of the problem was when everyone went home, the majority of toilet paper was manufactured for corporations that were being sent those huge boxes that are individually wrapped, the stuff that feels like, you're using sandpaper, right? Okay. So all that equipment and buildings that were used to manufacture and deliver this through corporations and employees was now no longer needed. And so the household toilet paper manufacturing was not able to keep up, which is why they started selling corporate toilet paper. You remember they were selling individual rolls for like $10, right, online. So this is kind of how that, so think about that one simple situation, and now extend that into oil companies are not producing as many drilling situations. They're slowing down production. The backstock's down. So this is all, we're catching up to where we had the slowdown. So we can go to the next one, Marche.
Uh-huh.
So inflation, people are worried about this. Sure, things cost more, but again, this is something that is usually not a long period of time. But as far as your investments go, these are some of the worst periods of inflation. You can see going back to the 30s. If you look at inflation on the right side there, 5%, 2%, those are the numbers going up. But look at the stock market on the far left column. you're still making, you had 1 year that was down in the 30s. That was only the depression. Then you had 8.5, 19, 7, 5, 17. So I think there's a strong case to be made that inflation is not really a factor in whether you should be in the market. Okay. And what really makes stocks go up and down? Well, in the simplest answer to that is you spending money. So I would challenge all of you to think, are you spending more or less money right now? I think we're all spending more than we did in the 80s, the 90s, the 2000s, especially a couple of years ago, if we're talking about just gas and food and certain things. So when we think about that, what makes stocks go up and down is two things. It's earnings. Are they making money? But the other factor is how you all feel, how we feel as investors. So the VIX is the volatility index. And what we tend to find is when the volatility index is going high, the market tends to be going the opposite way. And you can see that very, dramatically there back in 2008. See that big dip there? That's the market dropping in 08. And that big spike in volatility is people panicking, which you can see is correlated. One's going up, the other's going down. Now, we look at today on the far right, and you can see that the VIX is relatively moderate. That red line has not had a huge spike. I mean, it's higher than it was at the beginning of the year. But the market has come down accordingly. So we watch these trends to really get an idea of where's the market heading. So if you just think rationally, as things start to calm down, which you can see how it's dropping there on the far right. I don't know if you can show that, Marche, the far right on the red. See how it just dipped recently? Okay, and you can see this is a good sign that the market is going to start hopefully coming back up, is when that VIX starts to drop. Okay, we can go to the next one.
Oh, we had a question about the VIX index. Where is that? How is that measured?
So it's measured on basically the volatility of the market, how much trading is going on, and you can actually Google it, VIX, and you can see how it's tracked. But it's a measure of the market's inflows and outflows, and I'm sure there's a few factors that I'm not remembering, but it's basically volatility. It stands for the volatility index.
Interesting.
So in other words, the more people are buying, selling, and in large volumes, that's going to affect the VIX.
Got it.
So show me the money. Okay, we've heard this before. S&P 500. Okay, it really is one of the better performing indexes. It's made money over time. You can see from the chart here, if you had money in 88 to today, you've gone up. If you've had money in pretty much any 10-year period, you've gone up. The earnings is that orange line. So what's really important is the value of the S&P, the blue line. So if you look all the way to the right at 2022, you can see that blue line's dropped a little bit. But you can also see earnings are relatively high in comparison to the blue line. You can see that orange line is predicted to be. So if you see right now, earnings are a little under, just to the left of that kind of peach. Yeah, exactly, right there. Earnings are a little lower than the market itself, but what they're anticipating is by the end of 23 to 24, those earnings are going to match back up. So we feel like that recovery is happening, okay? So I think that's important because as we see those earnings start to get better and better, that S&P is going to start to grow back and turn, okay? Wall Street's on sale. I think this is important. A lot of people have this term Wall Street and they think very negative connotations sometimes. And I think we have to shift our mind frame here because emotion, because again, we want someone to blame. We want to talk about wealthy corporations and executives taking too high a pay. And that's all something that we can talk about. But on the positive side, you have to realize that you have an opportunity as an investor to be buying into publicly traded companies. You're basically a part owner. You might remember that commercial where the guy was bragging about how he owned, I can't remember the companies now, but Coca-Cola and Yahoo and whatever. And it's true, you are a part owner of these companies. So you're not having to invest millions of dollars to become an owner of a company now. You can do it for very little. And so when you think about Wall Street being on sale, this chart shows where prices tend to be a little higher versus lower or average. So right now, on the far right, you can see that green line, the top line. Our prices are still a little overdone, meaning there's still a little steam that might need to come off the market, but we're getting to that point. We're getting back to that, prices are getting lower. So a good money manager is going to be selective in trying to find what's on sale, putting that in the portfolio, but not buying things on sale that maybe don't look like they have a good forward profit. So, I mean, just think realistically, there's some companies that have been really beat up because people emotionally have been panicking and selling. So some of these stocks have been really taking a beating, maybe in an unwarranted way in some cases, meaning they were simply sold because people were selling out like a kind of a domino effect. And that relates back to that VIX, the volatility index. So you have to remember what money managers are able to do is discern, now that the dust is settled, we're going to go in and purchase things that have opportunity and stay away from things that maybe are a little bit concerning. Okay, hopefully that makes sense. Next slide. So take inventory. I think this is important. A good conversation with a wealth planner that can talk to you about what it is you're doing. Are you aligning your investments with your goals? I think one of the biggest risks we see people do is they just get too safe during these times when they should be thinking this as opportunity. Okay, and I'll use the quote of Warren Buffett that a lot of you have probably heard is, be greedy when others are fearful and be fearful when others are greedy. Okay, and so what that's really telling us is when people start bragging about how well they're doing buying gold from infomercials at 3 a.m, that probably means you don't want to be buying gold. Okay, but if people are bragging about how concerned they are about things and they're trying to look for the right opportunities, that's where people are starting to be, maybe a little scared. That's where it might be time to start thinking about getting back in or staying in it if you haven't jumped out. Needing to change investments. So this is a really important one. If you're working with a financial planner or you're doing it on your own, if you've set the portfolio up based on a conversation you had about what you're trying to achieve. So imagine, you're 40, you're 50, you're 60. We've talked about what you're trying to do. We put the investments in. The second the market has a downturn, the client calls us up and says, "Hey, Sean, the market's dropped. What are you guys doing with my portfolio to stop the bleeding?" This is the conversation we have. Okay. Well, the first question I ask them is, okay, Mr. and Mrs. Client, I understand you're concerned. Have any of your goals changed since we talked last year? And more often than not, they tell us, well, no, we're still planning to retire in 10 years or whatever they're trying to do. So what we have to explain to them is, well, we're constantly updating to adjust for the market. If your goals haven't changed, then your investment should be aligned properly. So you just have to kind of get through this period of time, right? You have to wait it out. So patience is really a virtue in this sense. You don't want to get impatient. And I think people do that. They get impatient. They turn on the news. They start listening to this. This is why we talk about turn off the noise, because you're going to get, I think we all know that news tends to be fear-based. It tends to be talking about what happened that was wrong. We have a little bit of positive sometimes. We get the one or two stories of the day, but from a rating standpoint, the news draws you in, whether it's on social media, whether it's on on TV or cable news. They're drawing you in based on that fear factor. And I hear a lot of things that are recommended on TV and different channels that you've got to be really careful about, actually acting on that. So always call your advisor before you just start making changes to your stuff, because that can make a big difference. What can I do to make the most out of a volatile year? Well, these are all the years going back in time that had big drops at some point. Okay, so how is it we're averaging a 10 to 12% return in these different markets when, look at some of these years. We had 30% drops, 40% drops, several in the high teens. And that's why want people to really start looking at investing in a different way. This is not a line where your money's just going up, right? Investing is a bit of a roller coaster, okay? But you're going to profit if you keep your head in, is the point here. So in a volatile year, I think the point is make sure you're in the right things, talk to somebody about that, make some adjustments if needed, but don't take your eyes off the big picture. An opportunity for some people, if you have non-qualified investments, meaning money that's not in an IRA, maybe you have, you sold a house and you have a couple $100,000 in an account somewhere, or maybe you just have been saving externally from your 401s. This is a time where tax loss harvesting can help. So this is where we go in and we can actually select certain investments that have been beat up. We can sell those with the thought that, well, let's think about it. If you sold out of a stock that was down 40% right now and it hadn't recovered, you could take that loss and reduce your taxes, because if you're not in an IRA, you've got to pay taxes on cap gains each year. So you can offset your capital gains by liquidating some companies, even if temporarily. Okay, it's got to be, you can't get back into those companies quickly. You've got to wait at least 30 days because of the wash sale rules. But you can always buy back, XYZ company before it recovers if you really want to. But in the meantime, you'll get that tax loss and be able to commit that to your gains, so it offsets those. So we have many investors that we've spent quite a bit of time doing that with this year, which can help improve their returns. So whatever little they might make this year will be enhanced by their tax write-offs. So turning off the news. So, some of these headlines from Time Magazine, you can see the blue one there. It looks like the bull's getting tackled by the bear, or at least he's not winning. Is the U.S. going broke? The deficit, America's black hole. Will I ever be able to afford to retire? You get the coronavirus. So, are these headlines all from the last couple of years? Because they sound pretty familiar, right? Well, from left to right on the top, that's 1950, 60, 70, 80. And on the bottom left there, is there a light at the end of the tunnel? That's the 90s, or 80s, 90s, 2000s, going from left to right. Okay, actually the far left one will be the 70s. So I think, we can pull out all sorts of headlines that rhyme true with today. And I think what's important there to remember is just because you're suddenly closer to retirement, or you're suddenly paying attention to your 401k, doesn't mean we haven't gone through a lot of this before. It is different, but it's similar in that we go through these cycles, okay? And so don't let any one major situation take you off track from your goals, because the market has fared very well through all of these time covers and has recovered, okay? So I think that's the majority of what we wanted to talk about today. I hope that gives you guys some insight on, trying to get your emotion in check and not let it steer you. One last little, tidbit is when you talk about investors that invest on their own, they've done many studies on this where they look at a group of advisors using a specific set of funds and a set of investors on their own that use the same exact set of funds over an equal period of time. So they're picking from the same thing, they're in the same thing, same period of time. The ones with a financial advisor typically earn about 3 to 4% more per year historically than the ones that are doing it on their own. Now, if I was to say, does anyone know why? Usually people come up with it eventually, but the main reason is people doing it on their own keep trying to time the market. They sell, they think they're protecting things, and they're going to jump back in, and then they're going to call their advisor even and convince them to get them out. Sometimes that happens, okay? But whatever the reason they're getting in and out, that will dilute your earnings because you're missing out on those key days, okay? Do we have any questions, Marcia?
We do have some questions, and you talked a little bit about timing. Maybe you can talk about how people could, there was a question here about, well, what if I want to get out of the market? Let's say that I'm retired and I need those funds. Well, what what kind of opportunity do I have if I can't wait to withdraw some of my funds in retirement?
Okay, so that's a little bit of a complex question, actually. So if you're retired right now, which the majority of our clients are retired, we're definitely looking at running a cash flow analysis to see, based on how much you have, can you draw money out to a certain level? So let's say a client has a certain chunk of money, we're going to give them a little guidance on what they should be drawing, and that amount should be sustainable while they're invested, even going through this type of time frame. So if they're drawing too much, then that could be a problem, just because they're not following good planning. But if they're drawing somewhere in the 3 to maybe even 5 or 6% range, depending on the period of time it's happening, and that's where we'd run all this in cash flow models to show them how they're doing. Being invested is critical, because that's how you're going to be earning, even if it just means we're at least in bonds, or we're finding alternatives that fit their risk profile. But that really would warrant a conversation with an advisor, I think, to kind of dig in deeper on that.
All right. Can you talk a little bit about some of the mistakes people make while they're nervous about the market?
Sure. That's a great question. So the mistakes made, I think the biggest mistakes are kind of going back to what I said, is don't take your eye off your original goal and strategy. Okay. So it would be kind of like, if you think about it, if you set this whole plan in place on what you're trying to do, and just because there's a storm outside, you decide to just blow up your whole plan and say, oh my God, I don't know what to do, and you run for the hills. Okay. That's where you got to really focus and get concentrated on, okay, is there anything that we need to fix? Is there a particular investment that's maybe problematic because of what's going on? We do a little analysis of it, but we still want to keep our head in the game and move forward. So the biggest mistake really is people that are just, we call it the swing of the pendulum, where a common thing that happens, if you just go back to January, let's say, market starts to fall. So if you did everything perfectly wrong, you would have sold out in the market, you would have moved it into cash possibly, and then you would have moved it into bond funds. Okay. Now, what's the risk of moving it into bonds right after the market falls? Well, what did they do to interest rates over the last 3 months? They raised them, right? So that's going to affect your bonds. Now, that's okay if it's a long-term decision, but if your intention is to get back in the market, you took a hit in the market now, interest rates go up, which caused your bonds to drop. So then you panic from another loss, and then you move to cash. And then this is where we get stuck, inevitably waiting for the market to do what? What are we waiting for it to do, Marche?
Go back up.
Go back up. Well, go back up. Why didn't you just stay in and wait for it to go back up? Because if you go and when it goes up, then you're buying high again. So then, well, how high do you want it to go up to get back in? And that's where a lot of times we miss out on that initial recovery, where people start to feel good again, and that can really dilute your earnings over, of recovering, or just in general. So the biggest mistake is making emotional changes that aren't based on your goals or logic. They're based on fear. And that's where we're watching the news, right? The news is scaring us. The end of the world's coming. We're all going to be living in holes in the desert. That type of mentality is, you got to kind of step that aside and just think logically. What makes the market go up is people spending money. And as long as people keep spending, it will recover. That's the thing you have to remember. Okay. What's the next question?
One of the questions came in about the growth of the market. Does that also account for inflation? So I guess they were referring to this, where like over time it looks like it's going higher and higher. Does that also account for inflation here on this kind of graph?
Okay, no, that would be a whole separate thing. So inflation typically happens in very specific periods where there can be shortages. So it's really supply and demand. Okay, so as we've had some of these supply chain issues, and we haven't been pumping out enough gas, no pun intended, but we don't have enough gas coming in as the workforce is getting out and COVID's opening up, it caused kind of a spiraling effect that there was a lag time. So then if people can't get their new computer or that flat screen, the companies are having a shorter supply. So they inherently raising prices because a couple of reasons. One, they might need to because they're not selling the volume anymore, right? So they have to up the price to make their profit to keep everything running. And the second reason is because if there's a shortage of product, they can, right? Don't think we don't pay more for gas because it's just, falling out of the sky. When there's a shortage, they tighten up, pricing goes up. So we have to get through this kind of bubble here where things start to slowly come back to earth. And the government only really has a few levers to pull to fix this. I know everyone wants Congress and Biden to just wave a magic wand and fix this stuff. And there are things they could do, but this needs to be quick things. This is not building new oil refineries and coming up with a third alternative energy. This is really digging in and finding what can we do quickly to make an effect and then let nature take its course. So we're already seeing, gas prices slowly coming down into the low $4, or getting back to $100 a barrel now. So those are signs to get us back to $4 a gallon at the pump nationally. So you have to really keep in mind that inflation should be not something that goes on forever. So you don't want to make lifelong investment decisions based on a storm that's going to pass. That's the way I would really think about it.
All right. Well, that's about all the time we have for questions now. Sean, thank you so much for being here. And I want to thank our attendees also for their great questions. While I'm doing my outro here, you're welcome to put any more questions you have in the chat. And we're happy to reach out to you after today's event to make sure we get those addressed. Well, to our attendees, look for a link to a replay of this event in your email. We'll be sending that out the day after the event. And then also, we want to thank the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming. Thank you, Sean. And we hope to see you at another webinar very soon. Bye, everyone.
Thank you, everyone, for coming.